Let's get to Wall Street right now. Stocks are attempting to bounce back from Monday's sell-off. It pushed the S&P 500 back into bear market territory. Right now, futures trading higher. This is where the markets closed, though. The Dow down just over 876 points. The NASDAQ down more than 530 points. And the S&P 500 down 151 points. Now, all three indices are down significantly from their highs for the year. The Dow is down 16%. The NASDAQ lost 30%. And the S&P down 21%. I know that is a lot to digest, but it's pretty plain. It looks like the writing's on the wall. Let's talk right now with NewsNation business contributor Lydia Moynihan about all of this. Overseas markets shifting quite a bit, especially in Asia. Where will we stand right now when Wall Street opens in just over an hour?
Yeah, look, European stocks are down marginally, but really overseas markets are a lot more concerned about what's happening in the U.S. than vice versa. You know, America has the largest global capital markets. And so it is good news that futures are up marginally, but still pretty flat. And the smart money is saying that there is just going to be volatility and uncertainty in the markets until at least Wednesday, when we will get more clarity from the Federal Reserve about what they're going to do with the Fed funds rate and how much they're going to be hiking it.
Yeah, and the Fed just raised interest rates again in, I believe that was April, but raising interest rates reportedly by the fall. How could that impact markets?
Well, historically, it's important to keep in mind that the numbers they're talking about are orders of magnitude smaller than they've been previously. In the 1980s, you know, Fed funds rates were north of 14%. What we're talking about now is just as much as maybe a 3% Fed funds rate by the end of the year. So historically, this is still extremely low. But again, we're going to get more clarity on that in Wednesday. And, you know, it's kind of this Goldilocks scenario for Fed Chair Jerome Powell, right? Because he needs to raise interest rates enough to tamp down on the systemic inflation, while at the same time not raising them so high that he pushes the economy into a recession. So it can't be too hot, can't be too cold. He has to get it just right. And that's what the markets are hoping he will be able to do.
Yeah, and I'm sure the Biden administration is crossing their fingers and toes as well for that Goldilocks scenario. Have they had any response to this bear market yet?
Well, they're obviously painting a pretty rosy picture of what's happening, and they're emphasizing that the labor market is very strong. And it's true. Right now, there are more jobs than people looking for jobs. But what a lot of people are concerned about is their policy response may actually be a bigger part of the problem than the solution. The Federal Reserve of San Francisco recently released data that showed at least 3 percentage points of this inflation that we are seeing is from all of the spending that we saw during the pandemic. And so what the Biden administration is proposing is $2 trillion more to help with the rising costs of inflation. And that could actually potentially backfire. And look, the markets aren't a political animal. They're not partisan. They're just responding to what they see. And that is an indication the past few days, you know, they've been down so much that they're not happy with the policy solutions coming out of the White House.
Lydia Moynihan, we'll check in with you when the markets open next hour. Thank you so much. Thank you for watching. Go to newsnationnow.com to find NewsNation on your television provider. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.